Welcome back. And in our business news, Dubai's Department of Economic Development has reiterated that no free zone company can conduct a business within Dubai unless it has a DED license or chooses to open a branch in Dubai in accordance with the conditions stated in Law number 13 of 2011 on business registration and licensing in the Emirates. A press release sent by the DED states that Law number 13 of 2011 enables free zone companies to open branches in Dubai while maintaining their presence in the free zone. Mohammed Shail Al Saadi, the Chief Executive Officer of the Business Registration and Licensing Sector of the DED, added that companies may appoint an intermediary to sell their products or services in Dubai, but the intermediary should have a DED license. The statement said that Al Saadi issued the clarification after reports in certain online media and subsequent inquiries on a free zone company in another emirate, claiming to be a virtual free zone, providing cheaper means of enabling international entrepreneurs to operate their businesses from a home or office anywhere in the UAE. The UAE's economy is set to grow at nearly 4% this year, off the back of a boost in the fields of tourism, services and industry, as well as higher oil prices, according to the UAE Minister of Economy. According to a local paper, His Excellency Sultan bin Saeed Al Mansouri, the UAE Minister of Economy, stated that in the first 9 months of the year, the UAE's GDP reached 1 trillion dirhams, and that the ministry expects real GDP growth to be 3.7% by the end of 2012. He added that a boost in tourism and manufacturing grew by around 3%, while trade rose by 4% this year. As for 2011, the UAE's real GDP grew by around 4.9%. He added that the UAE has managed to slash inflation from 14% in 2008 to just under 1% in 2011, off the back of a sharp fall in rents. He further stated that inflation in 2012 will be between 1 and 1.2%. And let's now take a look at the stock indices across the GCC. And looking to other news now, optimism on Friday that the two leading parties in the US are optimistic that a deal would be reached on the impending US fiscal cliff saw risk sentiments on the rise at the start of this week. The US dollar was weaker across the board as higher yielding assets and stocks were buoyed by the improving risk sentiments. Well, we earlier spoke to Gaurav Kashyap, the head of the DGCX trading desk at Alpari Middle East, to see what would be driving the markets this week.
The US dollar kicked off this week on a weaker note as renewed optimism from Friday's session showed that Democrats and Republicans were optimistic a deal would be reached with regards to the US fiscal cliff issue, which is expected to come into play at the end of 2012. Remember, the US fiscal cliff has been dominating the markets since the re-election of President Obama. Both parties have to find a way to avoid the $600 billion, which could be wiped off as a result of Bush-era tax cuts which are expiring, along with automatic ends to government spending programs. To put that in a bit of perspective, the $600 billion amounts to about 4% of the US GDP, and considering that the US is only growing at 2%, an automatic expiration of these tax cuts would see the US enter a severe recessionary state come 2013. So this optimism seen from Friday's session should probably carry risk markets higher into the week ahead. The US dollar should probably remain in the back foot. With regards to the euro, we're also watching for the Eurozone finance ministers meeting, which converge tomorrow on Tuesday, with regards to the additional tranche of bailout money for Greece. On Wednesday, we expect to see the Bank of England's meeting minutes, which could bring a slight surprise. And of course, we'll continue to watch for manufacturing data coming out of the Eurozone and Germany at the end of the week. But overall, the euro should remain weaker in the week ahead, and the US dollar should also remain on the back foot.
you.